Hello, my dear friends. I think you all might have gone through the news right 2 days back that RBI has right in its monetary policy committee has gone for a rate cut, right? And so many technical things, so many terminologies. I think you have gone across. And this particular monetary policy committee report, right, is quite important for your upcoming examination because the next committee will sit after 3 months. I think by that time your examination may happen. So this committee's report, whatever recommendation it has given, whatever its findings are there, and the back linkages, the concept of it is also important for your examination. So I think you might have all gone through the newspaper headings like this one from Economic Times, the RBC MPC opts for a jumbo rate cut, repo rate down, neutral gear. So many technical things are there related to MPC. You need to know about the rate cut, you need to know about the repo rate, you need to about the neutral stance, right? You need to know about the CRR, right? You need to know about from where it has shifted. There is shift to neutral. So from where it has shifted? It has shifted from accommodative stance, right? This you should know. So we will have a discussion on this. Both the parts will discuss, right? The current aspect of the MPC, what decision they have taken, and what will have its impact. And we will also try to know the concept of the same related to the what is concept of MPC, how it evolved, right? And what are its tools, how through which tools it controls the monetary flow into the economy. We will then discuss a good set of UPSC questions from the MPC, and we will also discuss a few questions related to the subjective because RBI, already has asked such questions in its previous year related to MPC descriptive, right? So we will discuss that also in our today's session. So have a patience and try to listen carefully the current part and the concept part, the C square, the current plus concept. We will try to discuss today in this today's session, right? Before we move on to the session further, just a request. You can right enroll or become a member for our Telegram channel by typing at clarity for sure in the search box, or you can like this video. If you like the explanation, you can share, and you can like this video in the YouTube by hitting the like button. Now, while understanding the overall system of this MPC, the monetary flow into the economy, the money flow into the economy, the how it is wiped out when it is injected into the system, so try to have a clear understanding of the four players in it. Try to have a clear understanding of the four players. The player number one is the central bank of that country, right? The player number two are the commercial banks or the scheduled banks of that country. The player number three being the inflation, and player number four being the economic growth of that particular country, and the people of the country through which the money is flowing ultimately, and the tools with the help of which the RBI or the central bank of any country is regulating this money flow into the hands of the people through the commercial banks to contain either inflation or to propel the engine of the growth in that particular economy. So the fight is in between the flow of the money, the inflow of the money to the RBI, inflow when there is excess money, and outflow from the RBI to the banks into the hands of the people, outflow, hands of the people, so that they have sufficient money to invest and there is a growth of country. So overall story revolves in and around these four players and the movement of the money and how the tools of the RBI is used to have a containment of the inflation by absorbing the excess money from the system into the bank, or there can be outflow of the money so that people get more money in their hands, and that can ultimately lead to growth, right? That is there. So these are the things we will be discussing. This is just a simplified version. We will discuss all the things in a much better way today. Now, let's have a look into the 6th of June news, right, related to the MPC. As you've seen that we started with the news from the Economic Times that talks about the MPC, right? It talks about the MPC over here. So we'll start our discussion with the MPC only. Let's see what does we have in our vault for this. Let's start with the history of MPC Monetary Policy Committee because this will keep on repeating. You should have a clear understanding, and both in RBI and NABARD they have asked question from the basics of the MPC, right? You can see UPSC also has asked the basic question from the MPC. I will right uh, make it available to you in the end of the session. So it goes back to 2016 when Dr. Ujit Patel committee recommended the formation of what? Inflation based targeting. Inflation based targeting. Before that, before 2016, before the Ujit Patel committee came into existence, don't you think that RBI was looking after the flexible inflation targeting or containing the target inflation in our country? What do you think? Yes or no? Please comment. Was RBI looking into the inflation directly? The answer is it was looking, but it was looking indirectly by different means, not through the liquid adjustment facility, right? It came into appearance only after the Urjit Patel committee's recommendation. So earlier it was going through different indirect, right, ways, indirect methods, more right, vesting on the methodologies like CRR, SLR, etc., to have right idea or the pathway so that the inflation in the economy can be contained. Now, once the Urjit Patel Committee came into existence, it amended the RBI Act of 1934, where it recommended that certain sections need to be inserted, which gives the power, the RBI, right, to contain the inflation, so that there is certain targeting should be done, right? That should be flexible and some target should be given to the RBI to overlook into this. And if the RBI is not able to meet that target within 3 quarters, successive quarters, then RBI will be answerable to this and RBI has to find the measure to contain the inflation. It was discussed under Section 45ZA that we should have flexible inflation targeting FIT. Okay? Now, Section 45ZB says that since it has set the target, so somebody there should be look into the target. So 45ZB talks that there should be monetary policy committee, right? There should be monetary policy committee headed by the governor of the RBI and two other ex officio members from the RBI and other members from the side of the government of India. So in total, there will be three from the side of the GOI, three the ex officio holders of the RBI, total six members, including the chairman, will be there in your MPC committee. And this MPC committee will be formed under section 45ZB. And this 6% will take a decision, right? As they have taken the decision 6th of June recently to have a 50 basis point rate cut. And this, whatever the rate cut they will have, right, they will publish after 14 days in minutes of this meeting through this section 45ZL that talks about the minutes of the meeting of this MPC. So this is about the MPC and its section, important section. There are many sections, but we are discussing important section that they have asked in the examinations earlier. So this MPC process is like that. The six members will get a notice before the 15 days to convene the meeting, start the meeting, and they will sit with the meeting process, right? Now, when the six people sit, it's not like that they will just have chit chat. They will take their decision on their whims. No, they take their decision based on certain information. They take their decision based on certain statistics. And this information, this statistics comes from certain secondary sources like the NSO data from the MOSPI, the data from the World Economic Outlook of your IMF. The data comes from the services of the MOSPI, agriculture data of the Agriculture Ministry or the MOSPI. It also comes the data from the different institutions related to market volatility, economic momentum. Now, when the six persons, right, uh, started with the meeting on the 6th of 5th and 6th of June, they had data and statistics from this. The every data from this secondary sources were on a positive note only, except the geopolitical tensions that are going in and around like Russia, Ukraine, India, Pakistan clash also was there. So all the data were quite favorable, quite positive, right? Quite positive in a manner that we can opt for growth and the imminence of the inflation that was there, it quite much controlled situation. The controlled situation is referred as benign situation of inflation. That is, it's not malignant, it's a benign situation, it is under control, and we can go towards the growth, right? Because the inflation is quite controlled, so we can cut the policy rate. Cutting the policy rate means decreasing the rate of interest. Decreasing the rate of interest means banks will get more money from the RBI at less rate of interest. More money means people will get more loans from the bank. People will get more loans from the bank means they can invest. More investment means more growth of the country. So that's why the RBI has opted for what? As you know, it is in the every headline of the every newspaper that there is a 50 basis point, right, cut in the policy rate, that is repo rate of RBI, through which it gives money to the banks of our country. So there is a cut of 50 basis points for the policy rate. This is the first major announcement. The second is there is a 100 basis points cut for your cash reserve ratio, right? This is the third announcement is your, there is a change in stance from accommodative to neutral. Fourth announcement is inflation announcement for year 2025-26 has been to 3.7%. And the fifth announcement is related to real GDP growth. Real GDP growth that is around 6.5%. So this main 5 points you should remember for your examination. This will obviously be asked, and one of the point can be asked in your examination, certainly, the 5 points. So these six people sat down, they took a decision based on the secondary sources, and they have decided to go for these rate cuts and all those things, what I told you, the five major decisions. Now the question is that, now the question is that how do this rate cuts will impact the economy? What is the basis of understanding of this? So we will discuss all this, right? But before that, one thing I told to forget that when the MPC is formed of the six members, when this MPC is formed of the six members, there is one term we call as quorum, that minimum number of members that should be there to take the decision. So it is 4 out of 6, right? That is there. And if there is a tie, right, 6% votes, if there is a tie, then the governor have an extra vote that is called as casting vote. And what is the frequency of the meeting? Frequency of the meeting is 4 times, at least 4 times in a year. It can be more than that also, that is there. Because that you should also know. It can be as an objective point of view. Now, these people sit, these six people, people sit to take the decision with based on this informations. Now, based on this information, they have to take a decision on two ends. The two ends are on one side we have, on one side we have, on one side we have the inflation, right? On one side we have the inflation. Inflation target. On the other side we have the growth target. So these six honorable people, the six dignitaries from the RBI and the government India, sees that on one side we want to have to contain the inflation, on the other side we want that our economy should grow. So this is a dilemma in their mind, right? This is a dilemma in their mind that what to do. Now, as the different sources of data, these sources of data tells that this inflation is in a benign mode, that it is silent, it is contained, right? And growth, we can have a right situation that promotes growth in the country, that promotes growth in the country. So this is a situation, right? अभी तो इन्फ्लेशन कंटेन है, ठीक है, इस पे हमें ज्यादा थोड़ा कम ध्यान दे चलेगा, बट हमें ग्रोथ चाहिए अभी कंट्री में. So RBI people on the government of India people, they voted for it and it was passed with a 5:1 resolution that we should go for the rate cut. We should go for the rate cut. Rate cut, right? What will happen with this rate cut? The rate cut will lead to cheaper loan, you can say, the cheaper flow of the money from RBI to the banks. When bank will have more money, it can give people more money. If people will have more money, it can invest those money. If it's invested, it will lead to growth. And since the inflation, the menace of the inflation is in benign stage, that's why this decision has been taken कि ठीक है हम फ्लो होने देते हैं क्योंकि इन्फ्लेशन तभी कम है, राइट? तो अभी थोड़ा बहुत पैसा मार्केट आ भी जाता है, if some money comes into the market, there is no problem for that because the inflation is in benign mode. That is there. That's why they have gone for a rate cut decision. That's why they have gone for a rate cut decision. And this type of situation where the central bank or the RBI is standing at such a point where it is looking into both growth aspect and it is also looking into containing the inflation aspect. Such stance is called the neutral stance. Okay? Where it is looking into the both, right? It is not overlooking anything, but inflation को भी ध्यान से देख रहा है and it is looking into the growth aspect also very carefully, then it is called as a neutral stance. But when the stance is such that it is looking only into the expansionist mode, it is looking only into the accommodative mode, जो कि कोविड के बाद से अभी तक चल रहा था, that was going on till now, then it is called as accommodative stage where we look for only growth. But when we look for containing only the inflation as was the situation after the recession of 2008, that was a hawkish stance, ठीक है, where we only wanted to contain the inflation. So this is the overall story, the short story, what has happened on 6th of June. 6th of June. Okay. Now we'll try to understand a little bit more the conceptual part of it. We have understood the what has happened on the 6th of June, what decisions were taken, based on what the decisions were taken. Now we will try to have some conceptual understanding of that. Please hit the like button if you are liking the session. Now we will move on to the monetary policy tool. Monetary policy tool. The decisions have been taken to cut the policy rate. If policy rate is cut, right? Policy rate is cut, that is repo rate. How it will impact the overall situation, we will study. Now let's see. See, there are two things. There are two things, right, in our mind. Monetary policy tool is a bigger set, and inside that we have a liquid adjustment facility. This is monetary policy tool. Monetary policy tool can be both for the short term, it also can be for the long term. It can also be for the long term monetary policy tool. And the liquid adjustment facility is for your short term. Liquid adjustment facility is for the short term liquidity, borrowings and all. So LAF, that is liquid adjustment facility, is a subset of your monetary policy tool that deals only with the short term borrowings and the liquidity. That is there. Now, when we say this monetary policy tool, this tool helps in both influx of money into the RBI, right? Influx of money into the RBI and outflux of money out of the RBI. When we say influx, that is money is coming, from which modes it is coming, which monetary policy tool we are using. The first is the reverse repo rate, right? Reverse repo rate. The second is your variable reverse repo rate. The third is your SDF, standing deposit facility. And the fourth one is your cash reserve ratio. Just I will explain each, but first understand that money is flowing into the RBI. There is influx through these four modes: 1, 2, 3, and 4. Reverse repo, variable reverse repo. Here the rate of interest is fixed as per the monetary policy committee's decision. Variable reverse repo rate depends upon the mechanisms of the bidding, the market mechanisms, the auction mechanisms, the market forces. The standing deposit facility is again fixed as per the decision taken by MPC. Cash reserve ratio as per the guidelines of the RBI, right? You know, this is there, and this also has been reduced as per the right decision taken by the MPC to 3%, right? By 100 basis points, it was reduced. So these are all the figures that helps money to move into the RBI from the economy or from the hands of the people through the banks. Through the banks only it is moved. So all this is helping in sucking the money from the system into the RBI, right? So when will RBI try to suck all the money? When will RBI try to suck or absorb all the money? When it will try to absorb all the money? When there is excess money in the market. When there will be excess money, when there is a inflation. So at time of inflation, RBI will try to absorb all the money through these different four monetary policy tools to absorb the excess money so that the menace of inflation can be contained. So that the menace of inflation can be contained. Okay, that is there. Now, when does it wants outflux of the money? When does it wants to have outflux of the money? When the system, right, does not have money, the people do not have money to invest. So RBI will want that it will give out the money, right, from its vault to the banks, and bank will lend to the people. So when it will happen? When RBI goes for a policy rate cut. When RBI goes for a policy rate cut. ऐसा सोच लो कि इंटरेस्ट रेट कम कर दिया, इंटरेस्ट रेट कम कर दिया तो बैंक्स विल, right, take more and more loan from the RBI and give more and more to the people of our country. If people will get more and more, it will lead to growth. So the message is clear. It will absorb when it wants to absorb the excess money to contain inflation. It will outflux, right, the money. The money will go out when it wants to have more money in the hands of the people and there is more growth in the economy. So inward movement to the RBI will happen through these four tools, and outward movement, the outflux will happen with this 1, 2, 3, 4 movement, like repo rate, right? That is a period of 1 to 15 days. Marginal standing facility does a period of 1 day. Bank rate, which is for a longer term. Long-term repo rate, again, 1 to 3 years. Long-term reverse operations, it is not a problem. Then we have statutory liquidity ratio that again bank has to maintain, right? Out of the cash deposits that they have, it is presently 18%, right? Bank deposit. And the yeah, CRR is, I told you, 3%. So total whatever advances or cash deposits you have, at 21% is has to maintain, 3% with RBI and 18% with them in the form of liquid assets like golds, cash, etc. Another mean by which the money can move in and out of the RBI is open market operation, OMO, by purchase and repurchase of the government securities, as you can see in the image, that is open market operation. That is open market operation. The money can move through this open market operations in and out by purchasing, repurchasing. Now you can see another image in this slide is the image of this eminent personality, that is Narasimhan. Committee's recommendation that came in 1998, it introduced the concept of liquid adjustment facility. Now here we are discussing all the monetary policy tools, the long terms and the short terms, everything. But out of this long and short, there are certain monetary policy tools which are only used for the short term, only used for the short term. So those tools which will be used for the short term liquidity adjustment will be studied under LAF, will be studied under LAF, liquid adjustment facility, that we'll discuss. Now from monetary policy tools from the bigger circle, we are moving on to a smaller circle of LAF. LAF is about short term liquidity. So to maintain that liquidity in the system, right, the policy rate cuts, whatever it has done, we will see the scenario. Now see, again the money is moving through the short, that is liquid money is moving for a short term. When the money is going into the RBI, when the money is going into the RBI, influx of the money, how it will go? Through standing deposit, right, facility, through reverse repo rate, and through the variable repo rate options, right? Only out of all the adjustments, SDF, standing deposit facility, is only such liquid adjustment facility or monetary policy tool, only such monetary policy tool where no collateral is required. Except for this, all other, right, monetary policy tools requires collateral. That should be kept in mind. So when we have studied that on 6th of June, there is a policy rate cut. Policy rate cut means the commercial banks or the scheduled banks, whatever they have, they will borrow more and more money from the RBI because rate of interest has been brought down. So they will borrow more and they will lend to the people more. That means they will promote growth, right? By following accommodative stance. But since they are looking for the inflation also, they have not totally left the balance of the inflation to look off. So now they have, right, uh, said that we have gone for a neutral stance from this accommodative stance because we are carefully looking to the inflation as well, though it is silent or benign right now. So that's why the policy rate cut, which has been done by 50 point, it is giving more money to the banks. It is flowing, it is helping on one side to the growth. Other side, they are silently watching the menace of inflation also, though it is in the benign stage. And how this money should be bought out of the system. How this money can be bought out of the system, right? That we have seen. Now, how this money can be bought into the system, that is to the RBI through this reverse repo, SDF, and VRR. One thing that you need to remember, see, there are certain situations we will discuss when the rate was accommodative. From COVID time till 2025, from COVID till 2025 June, it was accommodative, means it was looking towards the growth side. If we'll go towards the year 2008, after recession, the RBI was right having a monetary policy where it was going for a hockey stance, but it is wanted to contain the inflation. And right now in June 2025, it has gone for a neutral stance. So you have all the three examples that when RBI has followed the different type of stances, which has helped through this liquid adjustment facility to absorb or inject money from the system to right have the either economic growth or to contain the inflation that is there. Okay. Now we will discuss in this session with this concept, whatever we have discussed, we will discuss a few of the monetary policy tools in a nutshell. We will try to discuss. Now we will discuss one by one. Just 1 minute. Just read the questions. We will start the discussion within 1 minute. So the question number one in front of you is consider the following statement. In India, non-banking financial companies can access the liquidity adjustment facility window of the Reserve Bank. So see, the liquidity adjustment facility is available for the commercial and the scheduled banks, right? It is not available for the non-banking financial companies. It is also not available for the RRBs. That also should be kept in mind. So this statement is wrong. In India, foreign institutions can hold the government securities. Yes, they are allowed to hold for certain limit. Stock exchange can offer separate trading platform for debt. Yes, this is also right. So here option number 2 and 3 is correct. With reference to Indian economy, consider the following. If the inflation is too high, RBI is likely to buy government securities. If inflation is high already, there is too much money in the market. Why RBI will buy and again right impound money into the system? So this is absolutely wrong. If the rupee is rapidly depreciating, RBI is likely to sell dollars. Yes, if the rupee is depreciating, RBI will like to sell dollars because it has to make the position of the rupee stronger. When it will become stronger, the position of the Indian rupee, since now it is depreciating because supply is more and demand is less. So we need to increase its demand. We need to increase its demand, right? How we can increase its demand? So when we will sell the dollars, when we'll sell the dollars, so what will happen? Obviously, we will have more dollars, right? So it will increase its demand. So this statement is right. If interest in USA or Europe, obviously, कहीं भी कुछ rate of interest अगर गिरता है, तो we purchase it, we buy it. So this is also right. So here 2 and 3 are correct again. In central banks function, the lender of last resort means very important line. Lending to the trade industry से हमें नहीं कुछ करना है. Providing liquidity to the bank having a temporary crisis. ठीक है? Yes, we provide it for a temporary crisis. This is right. And budget deficit के लिए we do not go for the lender of the last resort. So option number 2 is right. If RBI decides to adopt expansionist, that is accommodative stance. Accommodative stance. ठीक है? If RBI follows it, then what it will not do, it is asking. So let's see what it will do. Expansionist stance means it wants growth. It wants growth means more money into the hands of the people. So cut and optimize, yes, SLR को cut करेंगे हम, right? It will do. Increase the marginal standing facility rate. No, it will not do. So this will be the right answer, because if we'll do this, then the money supply into the hands of the people will decrease. So it will not do this. Cut the bank rate. Yes, it will do this. So if they ask not do, only 2 will be the right answer. If they'll ask what will do, so 1 and 3 will be the right. So here only 2 will be the right answer. Next question, which of the following statement are correct regarding the monetary policy committee? It is decides benchmark. Yes, it decides. 12-member body, wrong. It's 6-member. It's function under the chairman of union, finance minister. No, it functions under the governor. So this is wrong. So only one is correct over here. Next, when Reserve Bank reduces the SLR by 50 points, India's GDP growth rate increases drastically. Wrong statement. Extreme statements are wrong drastically. Again, extreme line drastically wrong. Scheduled commercial bank may cut their lending rates. ठीक है? uh, FII may bring more capitals into the country. So the scheduled commercial bank may cut their lending rates because they will get more money. So C is right here. Option number C is right here. With reference to you, consider the following bank rate, open market operation. So public debt and revenue, which are the monetary policy tools. So as we have discussed in the entire session, bank rate and open market debt, 1 and 2 are the right option here. With reference to inflation in India, which of the following statement is correct? In controlling the inflation in India is responsibility of the government of India only. Only extreme word wrong. The Reserve Bank of India has no role. Again, extreme word. This is wrong. Decreased money circulation helps in controlling the. Yes, obviously, if money circulation is less, it is. So C is right over here. Next question, in context of the Indian Union, which of the following is purpose of statutory reserve requirement? To enable the central bank to control the amount of advances the bank can create, to make people deposit with banks safe, ठीक है? Nothing to do with this because DICGC is for that, to prevent commercial profit से कुछ लेना देना है नहीं, day to day banking और so one, I think one is the right answer over here. An increase in the bank rate indicates market rate of increase rate. Central no longer no. Central bank is easy note. It is following a tight money policy. When we increase the bank rate, means commercial banks will get less loans from the RBI, right? Easily, less money from the RBI easily. So it's following a tight monetary policy. Next, the Reserve Bank of India act as a banker's bank. Other bank retain their, yes, right. The right, RBI lends funds to the commercial, right. The RBI advises the commercial bank on monetary right. All three are right statements here. Then which of the following measures would result in increase in money supply in the economy? Purchase of the government from the public by the central bank. ठीक है. Deposit. See, liquid supply will only increases when the central bank injects money into the system. So when purchase of the government, it is purchasing the government security, right? So it is giving money to the outside. How's that? So this is right. Deposit commercial by the public, central bank nahi hai wrong. Borrowing by the government from the central bank, this is also wrong. So 2 and 3 are wrong, 1 is right here, because whenever we inject from the central government into the system, then only there is increase in supply. Lowering of bank rate by the Reserve Bank of India leads to, right, more liquidity in the market. Bank rate is reduced, so more money will flow into the system, right? Then what could be the descriptive question? Discuss the monetary policy tool used by the central bank to balance the growth and inflation. You can easily write down by watching the session once again what I have discussed with the examples. What are different types of stances in monetary policy with relevant examples? Explain the stances adopted by RBI in different conditions of the Indian economy. Easily you can tell with all the three examples I have given for the different stances in the different time frames when RBI has adopted for that. So that's all, my dear friends, related to the MPC and all those discussion what I have made. I hope it will help you to understand and solve more questions if they ask in the examination like that. So please do like the video, right? Subscribe the YouTube channel. Bye bye. Take care, my dear friends.